India's economy is on the move. In Q1 of FY26, GDP grew 7.8%, beating expectations. Inflation is at an 8-year low, interest rates are falling, and government spending on infrastructure is surging. But here's the real question. Which sectors will capture the biggest gains in the next 1 to 2 years? Let's dive into the data and uncover the winners and losers. To understand sector growth, we need the backdrop. India is outperforming most emerging markets. The IMF upgraded global growth forecasts, but India is already ahead of the curve. GDP growth, 7.8% in Q1 FY26, nominal growth at 8.8%. Inflation, lowest in 8 years, giving RBI room to keep rates low. Liquidity, surplus, making credit more available. Fiscal push, higher capital expenditure is driving demand across industries, but challenges remain. The rupee hit a record low at 88.2 per dollar in August. Exports are under tariff pressure, and foreign investors have been pulling money out. Despite this, domestic investors, mutual funds and retail have kept markets afloat. Now, let's look at the sectors that are likely to drive the next wave of growth. Financials. By FY27, financials will account for 37% of all corporate earnings. Falling interest rates are boosting loan growth. Insurance and asset management are expanding with rising middle-class wealth. Contribution, nearly 1/3 of incremental profit growth. Energy, the only sector with upward earnings revisions this year, accounts for 16% of incremental profit growth. Tailwinds, lower crude prices, expansion in renewables, better refining margins. Materials include cement, metals, and construction inputs, expected to add 15% of earnings growth, riding the government's infrastructure boom, highways, housing, smart cities. Industrials, machinery, engineering, logistics, and defense manufacturing, supported by public capex and Make in India push, expected to contribute around 9% to earnings growth. Communication services, the dark horse. After years of losses, telecom and digital services are profitable again. Projected 70% CAGR in earnings over the next 2 years. Key drivers, 5G rollout, higher data consumption, and digital platforms. High risk, high reward, small base but explosive upside. Some sectors, however, are losing steam. Consumer staples and discretionary weak rural demand, sluggish urban consumption. Earnings downgrades across FMCG and autos. Healthcare and utilities, negative earnings revisions, margin pressures, information technology. After 2 decades of dominance, IT is in a lull. Global clients are cutting spending and automation is reducing billing. Real estate margins shrinking as costs rise. Demand is slowing outside premium housing. Overall, India Inc. is still resilient. Q1 FY26 showed revenue growth of 6-7%, but margins hit multi-year highs, boosting profits. Nifty 50 companies saw PAT growth of 14.8% year-on-year. Nifty 500 companies posted 13.2% PAT growth. Excluding energy, revenue growth was even stronger. Consensus estimates suggest FY26 earnings growth at 11.6%, and FY27 at 15%, a healthy CAGR of about 13.3%. So what does this mean for investors? Core portfolio, safe bets, financials, energy, materials. These combine size, earnings momentum, and valuation support. Growth portfolio, government-backed. Industrials, strong pipeline of contracts and capex. High-risk portfolio, communication services, volatile, but could deliver outsized returns. Meanwhile, underweight exposure to consumer staples, healthcare, utilities, and IT might save you from sluggish performance. The next 2 years are not about every sector rising together. They're about picking the leaders. Financials, energy, materials, industrials, and communication services will shape India's market story till 2027. The rest will trail. In the end, markets reward clarity. And the clarity is here. Focus on the sectors with earnings strength, policy tailwinds, and consumer demand. Stay sharp, invest wisely, and ride the boom.